It looks as if investors already anticipated a pretty good fourth quarter earnings reporting period. So far through January 22nd, while the S&P was expected to lose 12.5% in that fourth quarter, now the forecast is for a decline of only about 8.5%. And technology is expected to be one of the better performers in this quarter. But I think that investors bought into that expectation and are now simply looking to take some profits. I think a lot of speculative investors are getting into the marketplace right now. They realize that interest rates are low and are likely to go higher, so they don't want to be investing in fixed income. They have cash on the sidelines. They might even be bored because of the coronavirus lockdown. So they want to invest. They've been seeing the stock market soar over the last several months, and they want a piece of the action. So I think we are finding that a lot of inexperienced people are taking on much more risk in the form of IPOs, in the form of options, or just in the form of investing where they had never done so prior. And as a result, that is what's pushing share prices beyond fundamental reasonable levels. When you have the Russell 2000 trade 40% above its 200-day moving average, which is the highest on record, when you see the S&P 500 trade on a PE that is 43% above its 12-month, its average over the last 20 years based on forward 12-month earnings, you do have to realize that sooner or later the market is likely to take a pause, likely to digest some of these gains. We are coming out of recession. Earnings are expected to move into the green in 2021. So still there is optimism ahead, but I think investors got ahead of this optimism. We had the S&P 500 growth minus value performance differential read an all-time high in the third quarter of 2020, mainly because consumer discretionary, communication services, and tech stocks did so well because of very, very low interest rates and the stay-at-home mentality. And while that was a warning signal, it's been taking some time for this to erode. And initially, the erosion occurred because investors worried that with the reopening of the economies, that would cause inflation to spike and interest rates to rise dramatically. Well, we're seeing interest rates move back lower, and what that is doing is causing investors to rotate back into the growth areas in general and the tech stocks in particular. So I think that investors are not willing to give up on these high growth areas just yet. I don't think that the stay-at-home period is going to last for the entire year. I still think it's most likely to last for the first half of the year. Merck decided that it was going to step away from developing a vaccine, whereas Moderna said that it was looking to create alternatives to combat the South African strain. So it seems as if those players that are already in the game are likely to develop different entities to fight the different strains. So the real question is, how efficiently can the states distribute these vaccines to those who have yet to be inoculated? So I feel that now, with an effort really being redoubled on this, that we probably will end up seeing more and more people inoculated by the middle of the year. Our expectation is that we'll see about a 5% growth for all of 2021. And maybe we'll have a couple of quarters in which we have 5.5% to 6% growth, but not beyond that. Our feeling is that it's likely to be a very strong year, but not in the 6 to 7 or even higher area.